Today, we are going to be covering Auditing Employee Benefit Plans, Part 1. My name is Melissa Critcher, and I'm going to be your discussion leader for our time together today. Upon completing this course, you should be able to differentiate between the various types of defined contribution and defined benefit pension plans. We are also going to cover the audit and reporting requirements for employee benefit plans. We're going to spend some time talking about the planning and risk assessment process, and then we'll mention and introduce some of the unique attributes that are associated with auditing employee benefit plans. Throughout this material, we will be discussing the rules and regulations from the IRS and the Department of Labor that are associated with employee benefit plans. We're going to, like I said, talk about the specific audit requirements and the reporting requirements associated with employee benefit plans, the risk assessment process, and we'll go through in our discussion the 3 steps to that risk assessment process, which include, identifying the risk, assessing the risk, and then responding to those risks. We're going to also cover the unique attributes that are associated with employee benefit plans and how these are unique and different from other types of financial statement engagements. This is just going to give you an idea of the materials and the topics that we're going to be covering in more detail. Some of these we'll spend a little more time on than others, but we will be covering all of these different areas and items. Starting here with Chapter 1, that's going to include all of your rules and regulations with your employee benefit plans. We're going to differentiate between our defined contribution and defined benefit plans. Then we'll mention and introduce the welfare benefit plans as well, the other different types of plans that you may encounter. And the one thing I'll mention now, and we'll go over this again a little bit later when we get more into these specific areas, is that once you understand the primary rules and regulations for auditing and reporting on an EBP, then those are going to be applicable to all the different types of plans that you may encounter. And then we'll make sure that you have the tools necessary to understand the unique attributes for each type of plan. Section 2 or Chapter 2 is where, again, we will be covering those specific audit requirements. We will also spend a little bit of time talking about the ERISA Section 103A3C audits. That is one of the new regulations that came into regulation here recently, so we want to make sure that we understand what's covered and required under an ERISA Section 103A3C audit. We also want to introduce some recent changes in legislation that has an impact on employee benefit plans, specifically the Secure Act and Secure Act 2.0. We will also, in Chapter 3, discuss the planning and risk assessment requirements. Planning for an EBP audit is one of the most critical areas, and we want to make sure that we know exactly what's required in accordance with our audit standards, but also talk about some best practices and how we can possibly be more efficient and effective as well. Chapter 4 is where we're going to introduce and basically wrap up that risk assessment with Step 3, where we're linking our identified and assessed risk to the actual audit procedures that we're going to be performing. So we're going to talk about how we're responding to those identified and assessed risk. And then last but not least, we will cover some more of those unique attributes surrounding employee benefit plans. So that gives you a very broad overview of the topics that we're going to be covering during our time together today. So let's just move right along here with our first section, where we're going to cover the rules and regulations surrounding employee benefit plans. Now, you've probably heard the term at some point associated with employee benefit plans, ERISA. And ERISA stands for the Employee Retirement Income Security Act of 1974. And this is a law here in the United States that sets the minimum standards for private industry voluntary employee benefit plans for both retirement as well as healthcare. ERISA is what governs the plans. That's the simplest way to put it. So we need to understand what these rules and regulations are in accordance with ERISA. Now, in order to meet the definition of a plan in accordance with ERISA, 4 attributes have to be present. And these 4 attributes include the fact that there have to be benefits, and those benefits will be defined in the plan document. You have to have participants, and those participants will have to have beneficiaries identified. The plan has to have a system of funding, and we're going to talk more about that when we get to the different types of plans, but it does have to have some type of system of funding, and it has to have an administrative system. So if those 4 attributes are present, then it meets the definition of a plan in accordance with ERISA. There are 4 titles under ERISA, all covering different aspects when it comes to employee benefit plans. Title I is where you'll find the rules for reporting and disclosure, vesting, participation, funding, fiduciary conduct, and civil enforcement. That's where we're going to focus our discussion, is in regards to Title I of ERISA. But just for your future information, Title II is where you will find the tax law requirements for EBPs. Title III deals with specific jurisdiction and enforcement procedures. And Title IV is applicable for your multi-employer benefit plans. So let's go ahead and start differentiating between the different types of plans that you may encounter. First, we're going to start with our defined contribution plans. Now, with a defined contribution plan, you will have individual participant account balances. And those individual participant account balances represent the amounts that are available to those participants for benefits in the future. So with your individual participant account balances, you're going to be testing to make sure that those allocations to those individual account balances are appropriate and in accordance with the plan document. With your DC plan, that's one of those unique attributes, is the fact that your DC plans have those individual account balances. When we get to our DB plans, you'll see that's one of the biggest differences, because in a defined benefit plan, you do not have individual account balances. Also, with your defined contribution plans, depending on the language in the plan document, you can have different types of contributions that come from both the participants as well as the plan sponsor. The participant contributions can be and are usually made on a pre-tax basis. That means they're withheld from the participant's wages before taxes, and then they're remitted to the plan and deposited in the participant's individual account balance. Now, some plans do provide for a Roth option, which allows the participants to contribute on an after-tax basis. The plan document will also specify if it allows for catch-up contributions. It will also define the different types of employer contributions that may be made to the plan as well. The employer contributions can be a stated dollar amount or a percentage, or be completely discretionary. But the language in that plan document will identify the exact types of contributions that are allowed. With your DC plans, because of those individual account balances, the majority of the time, employees have the responsibility to determine then the amount of their contributions and how they want those funds invested. The amount then that's available for retirement for the individuals in that defined contribution plan are based on those individual account balances, which are going to consist of contributions from the employee, from the employer, as well as hopefully investment earnings over a period of time. You have different types of defined contribution plans that you may encounter. Several of the most common ones include, obviously, the 401k plan. That is probably the most common DC plan you will encounter. The reason for that is because you have a lot of flexibility in a 401k plan compared to some of the other types. With your 401k plans, You have employer-sponsored, defined contribution personal pension accounts. With that 401k plan, as I mentioned, that employer contribution can be completely discretionary or a fixed match or some combination of the two. And you have the employee deferrals in your 401k plan. One of the advantages for a 401k plan is that the system of funding can be shared between the employee and the employer because the plan allows for both types of contributions. 401k plans are by far and away the most common type of defined contribution benefit plan. However, you could also encounter a 403b plan. A 403b plan works very similar to a 401k. However, with your 403b plans, there are only certain types of organizations that can sponsor a 403b plan. So a 403b plan can only be sponsored by a public school, college, or university, by a 501c3 entity, some churches. Again, those are the only entities that can sponsor a 403b plan. There are a couple of other unique attributes associated with your 403b plans that are unique just to that 403b that you would need to be familiar with if you are going to be auditing a 403b plan. Otherwise, outside of those few unique attributes for that 403b, they work very similar to a 401k plan. Another type of DC plan that you may encounter would be an ESOP. This is an employee stock ownership plan. With your employee stock ownership plan, again, you still have your individual account balances, but generally you only have contributions from the plan sponsor in an ESOP. A couple of the unique attributes about an ESOP is that they are allowed to borrow money to purchase additional employer securities, because that's one of the unique attributes of the ESOP plan as well, is that they have to be primarily invested in employer securities. So they're allowed to borrow money to purchase additional employer securities. But if the ESOP has borrowed funds to purchase employer securities, that's called a leveraged ESOP, and there are some additional reporting requirements for that leveraged ESOP. Now, there are a few reasons why a plan sponsor may choose to create and sponsor an ESOP. In most cases, it's simply to transfer ownership of the company and spread the ownership out amongst the employees. Of course, there are other reasons to sponsor an ESOP as well, but that's usually the most common reason why an employer would create and sponsor an ESOP. As I mentioned, the leveraged ESOP is when the plan has borrowed funds to purchase additional employer securities. A couple of other things to note about the ESOP is that in most cases, the plan sponsor is a privately held entity, and therefore the valuation of those employer securities that are held by the plan, they're going to have to be valued, and that is typically going to be performed by a specialist to be able to value the employer securities so that you can then test that valuation as part of your audit of the ESOP. And the price per share of those employer securities will fluctuate based on the performance of the company. Another type of defined contribution plan that you may encounter would be a money purchase pension plan. This is the only defined contribution plan that requires an annual contribution from the employer. All of the other DC plans, the employer contribution can be completely discretionary. But with the money purchase plan, they do have an annual required contribution to the plan. If the employer does have a money purchase retirement plan, they can still offer other types of plans as well. And there's no requirement or restriction related to business size, but the money purchase pension plan does also have to file a 5500 annually. Now, I personally haven't seen a money purchase pension plan in many years now, but there are still a few out there. And one of the reasons why we don't see a money purchase pension plan much anymore is because of all the flexibility that's available now in a 401k plan. So this little example that we have here, King Limited is a small company with 5 employees. So they've decided to offer a money purchase plan. Plan document indicates that all eligible employees will receive 5% annually deposited into the plan. This year, the company's total payroll was $150,000, requiring a $7,500 plan contribution to be deposited into the plan by King Limited. So that's just an example of where they would have that required annual contribution, but the plan sponsor still has the discretion to determine the amount. So you've heard me mention already once or twice the language in the plan document. Regardless of the type of plan that you're working with or auditing, that plan document is crucial to this process. The plan document is what governs the plan, and you're going to be testing to make sure that that plan is operating in accordance with that plan document. With your defined contribution plans, you could also have something called a safe harbor plan, and a safe harbor plan is one that requires an employer contribution to all eligible employees. Now, generally, you'll see your safe harbor plans with your 401k plans. And one of the reasons why a plan sponsor may adopt the safe harbor provision is in order to eliminate the non-discrimination test. Now, there are some, again, advantages and disadvantages to this. A safe harbor plan, since they require an employer contribution, they're going to be exempt from those non-discrimination tests, specifically the ADP and ACP test. Now, there are a couple of other requirements here to be a safe harbor plan. So first of all, you do have to have the required employer contribution, which is going to be fully vested, and the employer contributions have to be in accordance with the safe harbor rules. Some of these notice requirements have been eliminated under the Secure Act, which we'll talk about a little bit later on. But if it meets the requirements in accordance with the employer contribution and the safe harbor rules, then they're going to be exempt from that ADP and the ACP test. Now, the plan sponsor will have the option when it comes to adopting the safe harbor requirements to elect to defer, or to elect to contribute to only those employees who defer, or the employer contribution can be made on behalf of all eligible employees, regardless of whether or not they make elective deferrals. So we have another example here of a safe harbor plan. Machines and Tool Inc. provides employees a defined contribution retirement plan. The company decided to make the plan a safe harbor 401k plan. So in order to qualify as a safe harbor 401k, all employees received a contribution equal to 3% of their compensation, regardless of the amount of money the employee contributes. So once again, you have to read the language in the plan document carefully. Some of the different types of contributions that can be made to a defined contribution plan include the employer contribution, and it can be completely discretionary or it can be mandatory. Again, the plan document language is where you will turn to find out what type of employer contribution, if any, is allowed or required. With the discretionary contribution, you could have, for example, a profit sharing plan, and that profit sharing option may be based on the annual approval of management, and the dollar amount could be completely discretionary. You could also have the mandatory contribution, and the mandatory contributions can be based on different criteria. It could be based on things such as a specified match of the employee's contribution. It could be a stated dollar amount. Again, you'll just have to read the language in the plan document. And depending on the type of plan, for example, the ESOP, the employer contribution could be made in the form of cash or employer securities. Other types of contributions for your DC plans are on the employee side. We've already mentioned the fact that you can have the pre-tax elective deferrals, where the employee elects a specific dollar amount or percentage to be withheld from their wages, and they're not taxed on that deferral until they take a distribution from the plan. If the plan document allows, they could also have after-tax contributions, such as a Roth. You could have catch-up contributions, or you could even have rollovers from other qualified plans into that specific plan. As part of your EBP audit, you're going to be testing all the different types of contributions that are allowed, both the employee and the employer, because that's one of the compliance aspects of an employee benefit plan audit, is that we're testing to make sure that the plan is operating in accordance with that plan document. The next type of plan that we will discuss will be your defined benefit pension plan, a DB plan. Now, a lot of people think that there really aren't that many defined benefit pension plans out there anymore. And while it is true that a 401k plan is the most common and most popular, there are still some defined benefit pension plans that are in existence. One of the reasons why people think there aren't that many DB plans anymore is because in a defined benefit plan, the plan sponsor is the one that carries the sole responsibility for funding the benefits in a DB plan. So you will only have contributions coming from the plan sponsor in a DB plan. Also in a DB plan, you do not have individual account balances. So the benefits in a DB plan are going to be based on a benefit formula defined in the plan document. And that benefit formula can be based on the participant's age, years of service, compensation while employed, or any combination of those. So when one of the triggering events occurs in a DB plan, such as termination of employment, retirement, death, disability, once the triggering event has been triggered, then the benefit that the participant is entitled to receive is calculated. So because of the fact that the plan sponsor carries the sole responsibility for meeting the funding requirements in the defined benefit plan, a lot of the DB plans have become frozen over time. So once a plan sponsor makes the election to freeze that DB plan, they no longer continue to accrue benefits. They're still subject to the same audit and reporting requirements, though, even if they are frozen. So we do still have some DB plans out there that are still subject to the audit and reporting requirements. With your defined benefit plans, you're also going to have an actuary that's associated with that plan, and the actuary is going to be the one that performs the calculations in regards to the APB and the changes in the APB, which we'll talk about in a little more detail here in just a moment. And generally what will happen is that the plan sponsor provides census information to the actuary for the actuary to perform their annual calculations. So with your DB plan, you're going to be testing that census information to make sure it's accurate and correct, because if the census information is incorrect, then the actuarial calculations will also be incorrect. With your DB plans, you have generally two types. You have your traditional defined benefit, or you could have your cash balance pension plan. What I want to mention right now for both of these, both at the traditional and a cash balance, you will still have the actuary, and the benefits that are payable to the participants for both of these types of DB plans are still going to be based on a benefit formula. The biggest difference between a traditional DB and a cash balance DB plan is that with your cash balance plan, they will have these hypothetical account balances, which represents amounts that have been contributed to the plan on that participant's behalf. Because even in a cash balance plan, the benefits that are due to the participants are going to be based on a benefit formula, just like in a traditional. So looking here at this example, Peter Smith has a cash balance retirement plan through his employer and is getting ready to retire. So he has the option to take his retirement payments in a lump sum or an annuity. So Peter will receive $500,000 in lump sum, which represents the employer contributions and compounded interest applicable to his retirement account. If, however, Peter opts to take the annuity, it will be calculated based on this example. Wage times pay credit rate plus the account balance times the interest credit rate. And then that will determine Peter's annual retirement benefit. But again, all of that will also depend on the language in the plan document. The final type of plan that we will do a brief overview on is a welfare benefit plan. A welfare benefit plan provides various types of benefits to the employees. And with your welfare plans, it's going to be even more important to make sure you understand what type of plan it is that you're working with. The benefits that are offered in a welfare plan can be very, I guess the word I'm looking for here is that they're varied. That's the best way to put it. And some of these will be included in all welfare benefit plans, and other benefit plans, they'll just cover one or two of these items. With the welfare plans, what I generally find to be more difficult is finding a copy of the actual plan document. Yes, they may have the service agreements with the different entities that are providing some of these benefits, but they may not be able to easily locate the actual plan document. So be very careful with your welfare benefit plans that you can obtain all of the necessary documents. A couple of the other tricky things associated with welfare benefit plans has to do with determining whether or not the welfare benefit plan itself is funded. In order to determine that funding, that is not something you as the auditor need to be making that decision. The plan sponsor has to make that decision, and in some cases, they may have to consult with an ERISA attorney to help them fully understand whether or not that welfare plan is funded. If the welfare plan is funded, then it becomes subject to ERISA audit requirements. If the welfare plan is not funded, then it's exempt from ERISA. But these are a few of the examples here of the benefits that can be provided under that welfare plan. Dismissal wages, unemployment, vacation, health, recreational, all of those are different types of benefits that may be offered. The welfare benefit plan can also be a DC or a DB plan. In this example that we have here, Mary King has a Section 125 cafeteria plan through her employer. The cafeteria plan allows Mary to set aside a predetermined amount of her compensation in order to pay qualified medical expenses pre-tax. That's an example of a welfare benefit plan. Now, in this case, the Section 125 cafeteria plan is generally going to be exempt from the ERISA requirements. But you have to understand what those funding rules are, and they can be a little tricky when it comes to those welfare plans and determining whether or not they are subject to ERISA or not. You also have to understand what type of employer you're working with on these employee benefit plans, regardless of whether it is a defined contribution or a defined benefit plan. This is also applicable regardless of whether, in most cases, it's a 401k or just a traditional DB. But you do have different types of employers. You have, first of all, what's considered to be a single employer plan. And that's when you just have the one plan sponsor that is sponsoring and offering the plan to their employees. Now, a controlled group of corporations also meets a definition in accordance with ERISA to be a single employer plan. With your controlled groups, that would include your parent subsidiary relationships as well as brother sister. That would be in that definition of a controlled group. So with a single employer, you have one plan sponsor or one controlled group. And that plan document covers all of those employees as applicable, and you have one 5500 filing. So it's pretty straightforward with your single employer plans. Your employers generally have more control in your single employer plan as compared to multi or multiple employer plans. And that control is going to be more in the way of the plan design, as well as the operation and administration of the plan, and possibly even the investment options. Your multi-employer plans become a little more difficult. With the multi-employer plan, again, you have more than one employer participating in a multi-employer plan. And there's generally going to be a union contract, that collectively bargained agreement between the employers and the employees. With that collective bargaining agreement, that's again going to be that negotiated labor contract between the unions and management. Your multi-employer plans are going to be governed by a board of trustees, which is made up equally of members of management as well as the labor unions. That board of trustees determines the plan benefits. With this multi-employer plan, the cost associated with the operation and administration, they're all paid from plan assets. The multi-employer plans are generally also what's considered to be these unit benefit plans, where they have a specified dollar amount benefit per month multiplied by years of credited service. One of the other disadvantages with the multi-employer plans is the fact that your records are going to be spread out across the different participating employers. You also have the risk that one of the participating employers may not be operating the plan in accordance with the plan document. But with the multi-employer plan, again, you generally have that collective bargaining agreement between the union, labor unions, and management. One of the advantages to the participants in a multi-employer plan is that their benefits are portable from one participating employer to another participating employer. So with your multi-employer, even though you've got more than one participating employer, you still just have the one audit requirement and the one 5500 filing. Then that brings us to our multiple employer plans. Generally, with your multiple employer plans, again, you have more than one participating employer, but there's no collective bargaining agreement with the multiple employer plan. Again, these MEPs can be defined benefit or defined contribution. The plans are run by the sponsor of the multiple employer plans, because let's just say, for example, you've got 3 or 4 participating employers. They're going to have to designate one person or one entity to be the sponsor of all of the participating employers. And that sponsor is going to have those administrative responsibilities as well as some additional fiduciary responsibilities. Companies that are part of this multiple employer plan, they are still considered adopting employers. Now, multiple employer plans can also get very confusing and complicated very quickly. There's also multiple types of multiple employer plans. You can have a closed MEP, and with your closed MEP, that's when you have a group, association, or organization of unrelated businesses whose employees can participate in the retirement plan that's offered by that group, association, or organization. You can have an association retirement plan, which is similar to a closed MEP, but it's also available to self-employed workers. And you can have an open MEP. With an open MEP, there's no connection whatsoever between the participants and the participating employers. They're not related in any way, shape, or form. And there is a new type of open multiple employer plan that we'll talk about a little bit more detail when we get to our section related to the Secure Act. Now, all of these different types of plans, you have to understand and adhere to the rules and regulations, not just under ERISA, but also in accordance with the Internal Revenue Service. And these are specific in regards to tax qualification and compliance elements. And these include, the formation of the plan itself, making sure that the eligibility requirements are in accordance with the Internal Revenue Code, having and performing the non-discrimination test at least annually for those plans that are subject to the non-discrimination rules, and then adhering to the funding limits at both the participant and the employer levels. There are IRS deferral limits when it comes to your defined contribution plans, as well as total contribution limits. Now, this does not mean that you have to be an expert and memorize the entire Internal Revenue Code, but you do have to understand the basic rules that govern employee benefit plans, because you're testing to make sure that the plan is still in compliance with its qualified status. So some of these other qualification and compliance elements are surrounding the vesting provisions, which will be defined in the plan document and should be in accordance with the Internal Revenue Code as well. Distributions, plan terminations and mergers, all of those are various compliance and or qualification elements that you're testing as part of your EBP audit. Now, in situations where you do identify mistakes made by plan sponsors when it comes to the plan's operation and administration or qualification, there are ways to correct those errors. Specifically, the IRS has their compliance relief system. This is the EPCRS, the Employee Plan Compliance Relief System. And under that system, there are 3 ways that those errors can be corrected. You have your self-correction, the voluntary correction, and then the audit closing program. That all offer, different ways of correcting different types of mistakes made by plan sponsors. Both the IRS and the Department of Labor offers these correction programs because they want plan sponsors to be able to correct any potential mistakes while still being able to offer a retirement benefit plan to their employees. So just because we find a mistake made by a plan sponsor, it's not the end of the world. But what you do have to recognize is that those mistakes still have to be corrected. And that's, again, part of what we're testing to make sure that the plan is in compliance with the plan document, which includes being in compliance with the Internal Revenue Code as well as other ERISA rules and regulations. Now, these employee benefit plans, I've already mentioned a couple of times, the audit and reporting requirements. Those plans that are subject to ERISA do have to file a Form 5500 annually. And typically each year there are some minor changes, some more significant than others depending on the year. But for the 5,500 changes on the year 2022 Form 5500, these are those changes that you would need to be aware of. So they had some changes to certain schedules, including the Schedule MB for multi-employer DB plans, changes to Schedule SB for single employer DB plans, and changes related to Schedule R for retirement plan information. There's also some characteristic code options that are available on the 2022 5500. And then on Part 2 of the Form 5500 and the 5500 short form, they require some additional plan sponsor and plan administrator information. So again, those are just a few of the little minor changes that you'll find on the 2022 Form 5500. Now, if a plan meets certain requirements, then the audited financial statements have to accompany that Form 5500. If you do run across or have the opportunity to audit what's called an 11K 401k plan, they have some additional filing and reporting requirements because an 11K 401k plan is one that is registered with the SEC, and their filing deadlines, for example, are different than other types of 401k plans. But generally, for all of your other benefit plans that are not 11K, the 5,500 is due 7 months after the plan's year end. So for a calendar year-end plan, that initial filing deadline would be July 31st. That's for, again, calendar year-end plans, 7-month deadline, which would be July 31st. And there are two ways that that filing can be extended. The first, which is generally what I would recommend to all of my clients, is that they file the Form 5558 by the original filing deadline. So in our example, for a calendar year-end plan, the original filing deadline is July 31st. So if they file the 5558 by July 31st, then the filing is extended for 2.5 months. So now the extended due date would be October 15th. The second way that the 5,500 can be extended is based on the extended due date of the plan sponsor's corporate return. So, for example, let's say both the plan sponsor and the plan have a calendar year end. The plan sponsor extends their corporate tax return from March 15th, and the corporate deadline is now September 15th. The plan's 5,500 is automatically extended up through the plan sponsor's corporate tax return extended due date of September 15th. And they don't have to do anything. But what cannot happen is that the plan sponsor get to, let's say, September 10th and realize that, okay, we're not going to have this ready by September 15th, and now we want the extension till October 15th. They can't do that because the only way you can get that extension to October 15th for a calendar year-end plan is to file the Form 5558 by July 31st. Your plans also have to be covered by a fidelity bond. This is another one of those rules and regulations that can sometimes get overlooked by both plan sponsors as well as auditors. But every plan must be covered by a fidelity bond. Now, a fidelity bond is something completely different than fiduciary liability insurance. Those are two different things. A fidelity bond is required by the Internal Revenue Service. And this bond, it's a type of insurance that covers in case of fraudulent or dishonest actions. So it protects the participants and protects the plan assets in the event of fraud or dishonest action. So it does protect the plan against monetary losses. Now, the fidelity bond has to cover anybody who has the ability and or authority to handle plan assets. The minimum amount of the bond that is required is $1,000. The maximum amount that's required is $500,000. Unless the plan has employer securities, such as an ESOP, then the maximum amount is $1 million. But that bond amount must be equal to at least 10% of the beginning plan assets. So I always ask for a copy of that fidelity bond to make sure that it's for the correct amount and that they are maintaining that fidelity bond, because a lot of times it will expire and the plan sponsor will accidentally forget to renew the bond. I also want to point out that the bond is a separate document. It can be included with the plan sponsor's general umbrella liability policy, but it has to still be a separate fidelity bond. It can't just be ERISA coverage or fiduciary coverage. It still has to be the fidelity bond. So what you're looking for on that bond is, first of all, to make sure it has a specified dollar amount in accordance with those provisions. Make sure that the bond names the plan as an insured, not the plan sponsor. It has to name the plan as an insured. And there can be no deductible associated with the bond. and then understanding who's covered by the bond. Those are the things you're looking for in regards to the fidelity bond itself. So again, that was a very brief overview of some of the rules and regulations covering employee benefit plans and the different types of plans that you may encounter. But let's move on and talk a little bit more about the specific audit and reporting requirements. So we have, some FASB ASC sections that are dedicated specifically to DB plans, and that's in accordance with FASB ASC 960. 962 is for your DC plans, and 965 is for your health and welfare plans. The Internal Revenue Code covers areas related to income taxes, estate and gift taxes, excise, procedures, and administration. We all know that. The Internal Revenue Code covers many, many areas. But we don't have to be familiar with all of those areas. We just have to be familiar with the portions that are associated with employee benefit plans. So we have rules and regulations that are covered under the Internal Revenue Code. We mentioned at the very beginning of our discussion that ERISA also governs employee benefit plans, and it's ERISA that mandates an annual audit of the plan's financial statements and the fact that the annual audit has to be performed by an independent qualified public accountant. Now, just because you're performing your audit and you're performing your audit in accordance with auditing standards, that still does not guarantee that that plan is going to be in compliance with all of the rules and regulations in accordance with ERISA, the DOL, and the IRS. But you do need to at least be familiar with what those specific rules and regulations are. And your plan document is what you're going to be using, because the plan document is what governs the plan as well in accordance with the IRS and ERISA. And you're testing to make sure the plan's operating in accordance with that plan document. So what are these audit requirements? First of all, what we have to determine is whether or not the plan is considered to be a small plan or a large plan. With the requirements, your large plans are subject to the audit requirement. Your small plans are exempt from the audit requirement. So how do we define a large plan and a small plan? Well, a large plan is defined as a plan that has 100 or more eligible employees as of the beginning of the plan year. Now, this is an area where plan sponsors often make mistakes, because they'll look at their plan and they may see, oh, well, we only have 90 people participating in the plan, so we're a small plan, we don't have to have an audit. Well, they may only have 90 people participating in the plan, but they may actually have 135 that are eligible. So when we look at that eligible number, that includes anybody who's eligible to participate, even if they elect not to. It includes terminated or retired or separated employees that still have account balances in the plan. All of those individuals are included in that eligible employee count at the beginning of the year. So if they have 100 or more, they are considered to be a large plan, and large plans are required to have an audit performed. Your small plans, those that have fewer than 100 eligible, are exempt from the audit requirement. Now, we also have something called the 80-120 rule. I'm going to talk about that 80-120 rule here on the next slide. Couple things here I just want to mention before we get into the 80-120 rule in regards to the audit requirement is, as part of these rules and regulations, you're also going to be determining whether or not you've been engaged to do an audit in accordance with ERISA Section 103A3C or a non-ERISA Section 103A3C. And what that means is, with your ERISA Section 103A3C, is that you're going to be obtaining a certification from a qualified institution that they certify that the investment information is complete and accurate. And you are not going to be testing the investments at the plan level when it comes to purchases and sales, gains and losses, and fair value. That would be in your ERISA Section 103A3C. So that's important here to determine, as you're evaluating whether or not it's a large plan or small plan, because that's also going to be the next question, is what type of audit are you going to perform? Then, if your plan does meet the audit threshold, like I said, those financial statements that have been audited are going to accompany that Form 5500 filing. But first of all, coming back to determining when that audit is required. So we went over what that definition of a large plan and a small plan is. Now we have that 80-120 rule. And under the 80-120 rule, it basically says that if you have less than 120 eligible, then you can waive the audit requirement. But to make this a little easier to understand, let's go through this little chart here. The first thing you have to look to see is, what did your plan file in the prior year? So let's start here on the right-hand side. Let's assume last year the plan filed a small plan with the Schedule I. Then you look to see how many eligible participants they have as of the beginning of the plan year. If it's fewer than 100, then they continue to file as a small plan. If it's between 100 and 120, then they have a choice to file as a small, or they can file as a large and have the audit performed. If they have more than 120, then they don't have a choice. They have to file as a large and have the audit performed. Now, the only difference here is on the left-hand side is, once the plan meets the audit threshold and they have an audit performed and they file as a large plan with the Schedule H, they have to continue having that audit performed until the participant count falls back below 100. So this 80-120 rule, they can file under the 80-120 rule indefinitely, year after year after year, as long as they don't go above 120. So just give you a half a second there to think about that. And what I also caution auditors and plan sponsors is, please don't wait on the service provider to tell you when an audit is required. You'll be monitoring your plan for when it does go above that threshold, because if you wait around, possibly on the service provider, you may get to that date of October 1st and realize that you do have to have an audit performed, and that deadline's October 15th, and that's going to be next to impossible to complete. Now, your small plans, as we mentioned, they are exempt from the audit requirement as long as they're in compliance with the small pension plan audit waiver. And under the audit waiver, all that says is that the plan has to have at least 95% qualifying plan assets. So a qualifying plan asset includes your common stocks, your bonds, your mutual funds, your collective investment trust, your pooled separate accounts, etc. And they also have to provide a summary annual report to the individuals participating in the plan. Now, what happens if the plan does not have 95% qualifying plan assets? Well, the first thing they would have to do is make sure that they have an appropriate bond that covers those non-qualifying assets. So as long as they have the bond covering the non-qualifying, then they would still meet the requirements and be considered exempt from the audit under the small pension plan audit waiver. Now, as I was saying, that ERISA Section 103A3C audit is one in which the management of the plan, they are electing to exclude the investment information that's held by the qualified institution from the audit. So they would then obtain a certification from that qualified institution that says that the investment information is complete and accurate. And that would then allow management to direct the auditor to perform an audit in accordance with ERISA Section 103A3C audit. With this type of audit, the auditor is going to be issuing an opinion on the certification itself, as well as an opinion on the financial statements. Now, the ERISA Section 103A3C audit is still fairly new. This came about as of rule and regulation changes in accordance with Congress and the Department of Labor allowing and accepting 103A3C audits. But it's AUC Section 703 is where you'll find additional information related to the auditor's opinion in accordance with an ERISA Section 103A3C audit. There are some additional, I don't want to specifically say procedures or extensive documentation related to an ERISA Section 103A3C audit. For all of us that were already doing everything that we were supposed to be doing when it comes to an EBP audit, the changes under SAS 136 and the AUC 703 reporting, we're only going to have to make a few minor changes, as I'm sure you're already well aware of, since this standard is now already in effect. But under the 103A3C audit, you are going to have to include some specific terms of the audit engagement. We're going to have to consider specific laws and regulations when it comes to the audit of the financial statements. We have our communication requirements and some specific representations we're going to have to obtain as well. This is different than historically what we have reported on when it comes to our EBP audits. Historically, we had what was called full scope and limited scope audits. And just to, again, as a brief reminder, the ERISA Section 103A3C audit is essentially the same thing as what we referred to in the past as a limited scope. The big difference is that now under an ERISA Section 103A3C, we are issuing an opinion. With the 103A3C, the qualified institutions include your banks, insurance carriers, trust companies, an entity that's regulated by state and federal agencies. Those are all considered to be qualified institutions that could provide that certification. With the changes in some of these rules and regulations, a couple of things that we do need to remember going forward, because some of these changes started taking place in 2021 and 2022 and are going to continue to be implemented in 23, 24, and 25, as you'll see here, as a result of some of these recent legislative changes. Now, the Secure Act itself was passed back in 2019. But some of these changes, as a result of the original Secure Act, are going to require plan amendments in 2022 and or 23 and or 24. Now, with the Secure Act, there were some changes here in regards to the required minimum distributions, the age, and so they increased that age from 70 and a half to 72. The Secure Act also allowed certain part-time employees to make contributions to the 401k plan. This was called the long-term part-time employee rule. And that was being spread out over a 3-year period, and that started as of 2021. Now, I'm just mentioning that now because when we get to Secure Act 2.0, some of these items here are changing as well. The original Secure Act also allowed for distributions associated with birth and adoption. Again, some of these items took place and took effect as of 2021 and then moving forward 2022. We now have Secure 2.0 Act, and this was signed into law at the end of December 2022. And Biden signed in the 2023 Consolidated Appropriations Act. The law contains significant changes to the retirement plans for both employer-provided and individual retirement plans, and they are referred to under this Consolidated Appropriations Act as Secure 2.0 Act of 2022. Now, please bear with me here for the next couple of minutes as we go through these very detailed changes here under Secure 2.0. A lot of dates, a lot of numbers. You're going to have to make sure that you're working with your plan sponsors so that they're familiar with these changes changes and when they take effect, because they will require the plan documents to be amended. So one of the first things we need to point out, I mentioned just a second ago that under the original Secure Act, they increased the RMD age. Well, here under Secure 2.0, they've increased it again. So starting in 2023, the RMD increases to age 73 for an individual who attains age 72 after December 31st, 2022, and before January 1st, 2033, they reach age 73. So that's what it says. Some of these changes here, a lot of numbers and a lot of dates. And you can go directly to the Secure Act itself to get more information on these items. Starting in 2024, the Roth accounts and employer-sponsored plans, such as your 401k plans, will be exempt from the RMD rules while the participant is alive. The Consolidated Appropriation Act will allow a spousal beneficiary of an employer-provided plan benefit to elect to be treated as an employee for the purposes of the RMDs. Secure 2.0 also included some changes to the catch-up contribution limits. So beginning in 2025, catch-up contributions for participants between the ages of 60 and 63 in non-simple plans increases to the greater of $10,000 or 150% of the regular catch-up amount. Okay, the next item here, starting in 2024, all catch-up contributions to non-simple plans must be Roth contributions for participants with compensation equal to or in excess of $145,000. Also, beginning in 2025, the catch-up contribution limit for participants between the ages of 60 and 63 in a simple plan will increase from $3,000 to the greater of $5,000 or 150% of the regular catch-up. So stop and think here for just a quick second about the changes related to the RMD ages and these changes here to the catch-up contribution limits and the different dates in which these items go into effect. How that's going to impact your audit plan. Making sure that the plan sponsor has properly implemented these items, that these amounts are being properly administered within the plan's operations. And test your testing procedures. You're testing to make sure that all of those catch-up contributions to non-simple plans must be Roth contributions for certain people. So there's a lot of moving parts and pieces here under the Secure 2.0. So you need to familiarize yourself. You may need to have conversations with your plan sponsor, and you're going to need to have your plan sponsor work closely with their service provider to make sure that they get their plan documents updated accordingly. Secure 2.0 also had some changes that impacted 403B plans. They are conforming the current hardship distribution rules for 401k plans to be the same for 403B plans. 403B plans will now be allowed to invest in collective investment trust. Also, beginning in 2023, 403B plans can join a multiple employer plan or pooled employer plan. Roth elections for matching contributions. Participants may make a Roth election to employer matching. We also have a new automatic enrollment and escalation for new 401k and 403b plans. Now, this starts in 2025, where most new 401k and 403b plans must meet the requirement for an eligible automatic contribution arrangement with an auto-enroll default rate between 3 and 10 with a 90-day unwind feature, an automatic escalation of 1% per year up to a maximum of at least 10%. Some of these changes here, as you can see, are, again, trying to increase participation in the plans, especially that last one there with the auto-enroll and even the auto-escalate. A couple of other changes here under Secure 2.0, increased dollar threshold for mandatory distributions. That involuntary distribution threshold will increase from 5 to 7,000. Beginning in 2024, employers can make matching contributions based on an employee's qualified student loan payment. Secure 2.0 also allows for some emergency withdrawals. So starting in 2024, a participant can withdraw up to $1,000 per year from their retirement account for certain emergencies. The withdrawal will be taxable, and it can be repaid within 3 years, and it's not subject to the 10% penalty. But only one withdrawal is permitted per the 3-year repayment period if the first withdrawal has not been repaid. So as you can see, lots of changes here under the Secure 2.0. It's going to require changes in operation, record keeping, administration, the plan document, the audit, etc. Secure 2.0 also created pension-linked emergency savings accounts, these ESAs. So starting in 2024, the CAA allows employers to create an emergency savings account as part of a DC plan. So for non-highly compensated employees, the employer may enroll the individuals in an ESA up to 3% of their compensation, but maximum contributions cannot exceed $2,500. And all contributions must be made after tax. Each month, participants may take withdrawals from their ESA, and their first 4 withdrawals for a year cannot be subject to distribution fees. And then changes affecting long-term part-time employees. The original Secure Act said long-term part-time employees, if they worked more than 500 hours over a 3-year period, then they must be allowed to participate. Well, the CAA modified that rule and said now instead of being 3 years, it's 2 years. So for employees that work at least 500 hours for 2 consecutive years, they must be allowed to participate in the plan. And this extends that long-term part-time employee provision to 403B plans that are subject to ERISA as well. Couple of other things here under Secure 2.0. They did expand the employee plan compliance resolution system to add some additional items that were available for self-correction. They provided for retirement plan overpayment recovery, enhanced tax credits for new smaller plans, some family attribution rules, and most of these changes, and that's what I said, you have to be a little patient there for a few minutes while we talked about the Secure 2.0, because as you can see, there were a lot of different dates as to when these provisions take effect. The majority of them, are taking place over a multi-year period. They're all going to require the plan documents to be formally amended, but they do have a little bit of time before the plan documents have to be formally amended. So they have until the end of 2025 to make the plan document amendments as a result of Secure 2.0. Secure 2.0 also extended certain amendment deadlines for changes made under the original Secure Act as well. So we have a lot here to absorb, to familiarize ourselves with, make sure our plan sponsors understand, and make sure that they get the provisions adopted accordingly and their plan documents updated as well. So you heard me mention a little while ago one of those recent changes, specifically in regards to the ERISA Section 103A3C audits, and this came about as a result of SAS 136. And 136 was part of the whole suite of standards that all became effective at the same time, and 136 amended various other statements within our auditing standards. Here are just a brief overview and review of some of those objectives of SAS 136, and I'm not going to go through these in detail since these are already now effective, and then you should have put them in place for your 2021 plan year audits and going forward. Some of the key provisions here, obviously under a 103A3C audit, is we no longer have a scope limitation. It's a two-pronged opinion. And then we have management's assessment about the certification coming from a qualified institution. With the SAS 136, and again, I'm just going through this very quickly because we've talked about SAS 136 for numerous years now, and it is in place, it is effective. You need to make sure you properly document your compliance with SAS 136 and that you're using the correct audit report in accordance with 136 and AU-C section 703. With the certified investment information, for your 103A3C audits, you do need to identify who that certified institution is, what's covered by the certification. Make sure that the certification contains those words complete and accurate, and that the certification is signed, and it should be on letterhead as well when it comes to that certification. Significant changes to the auditor's report as a result of SAS 136. Historically, when we had a limited scope disclaimer of opinion, the report itself was about 1.5 pages. The standard unmodified auditor's report in accordance with SAS 136 is about 4 pages long. Lots of clarification when it comes to management's responsibilities and the auditor's responsibilities. And of course, you obviously have your two-pronged opinion. Please be sure you are using the correct auditor's report in accordance with AU-C section 703 and SAS 136, because that is one of the biggest things that the Department of Labor is looking for with the filings through the EFAS2 system of the 5500 and the financial statements. If the wrong audit report has been used for that plan year, they are pretty much considering rejecting that filing altogether. So make sure, again, you are using the correct audit report in accordance with AU-C section 703 and SAS 136. So the financial statements. For all of your benefit plans, you're going to have a statement of net assets available for benefits. That's basically your balance sheet. And that statement of net assets available has to be comparative, even if it's the first year that the plan is subject to the audit. You always have to show a comparative statement of net assets. The prior year, if it was not subject to the audit requirement, it can be prepared, compiled, reviewed, or audited, but you do have to show a comparative. Your statement of changes in net assets, you can show a single year. That's all that's required. That's basically your income statement. Now, your defined benefit plans, they do have some additional information that has to be presented, and this includes the APB I referred to earlier, your accumulated plan benefits, and your statement of changes in accumulated plan benefits. And the information for those two items will come directly from the plan's actuary. Now, this additional information for your DB and your health and welfare, they can be presented on separate statements. They can be presented as part of your statement of net assets and changes in net assets, or they can be disclosed in the notes to the financial statements. Your health and welfare plans will have an additional statement of plan benefit obligations and changes in plan benefit obligations. Your statement of net assets available for benefits is made up of your total assets, which is going to include your investments, your receivables, cash. Then you have your total liabilities that are subtracted from the total assets, and your liabilities include things such as operating expense payable or refunds of excess contributions. Those are liabilities. So you subtract your liabilities from your assets to arrive at your net assets available for benefits. The investment information on your financial statements, your investments should always be presented at fair value unless you have what's called fully benefit responsive guaranteed investment contracts. And then your fully benefit responsive GICs are at contract value, but all other investments should be at fair value. The items on your statement of changes include the change in the fair value of the investment, so that would be your net appreciation or depreciation. Then you've got your investment income exclusive of the changes in fair value, such as your interest and dividends. You're also going to have your contributions broken down by type between the employer contributions and the employee contributions, as well as rollovers. You're going to also have your withdrawals or your deductions from net assets, which include your payments to participants for distributions and other withdrawals, as well as your expenses. So please note here that those benefit payments, you record the benefit payments when they are paid. Plan expenses are also included on your statement of changes. And again, these would only be expenses that are paid by the plan. If the plan sponsor is paying some or all of the plan expenses, they do not get reported on the plan's financial statements. That would just be a simple disclosure that says certain plan expenses have been paid by the plan sponsor and are excluded from these financial statements. So that brings us then to our planning and risk assessment section. So we're going to spend a little bit of time here talking about the requirements in accordance with the risk assessment standards and why they're so important. And we'll talk about some best practices and procedures here associated with planning and risk assessment as well. We've done that broad overview of the rules, the regulations, the audit and reporting requirements, and introduced you to the financial statements. Now we're bringing it back down to the actual audit process, starting here at the very beginning of the audit with our planning and risk assessment. So during your planning phase, you're going to be discussing things such as the timing of the audit, the scheduling, the due dates. That's going to incorporate you obtaining an understanding of the plan and its environment, your preliminary analytical reviews, your brainstorming sessions, and your communications. And all of these, are combined together to represent part of that risk assessment process. And we're going to break down that risk assessment process into each of the appropriate steps. Planning and risk assessment, go hand in hand. As part of this process, we're also going to be considering how can we maybe incorporate some efficiencies and effectiveness if you audit both the plan sponsor and the plan. Are there some areas, for example, maybe related to payroll, that you can consolidate some of your efforts to maybe, again, save a little time between the two different engagements? But again, that will be entirely up to you. And if you only do employee benefit plan audits like me, then obviously there's no coordination between the two engagements. You do, however, have to always consider payroll, and that's because so many of the plan's operations are based on the payroll controls as well as the compensation. You have to get an understanding of that payroll, whether the company does their payroll in-house or they use a third-party payroll company. Are there any internal auditors that are associated with the plan sponsor that you could possibly utilize as part of your audit process? The location of personnel records and whether or not the personnel information is in hard copy form or electronic form. And with the changes in technology over the years, our audits have had to change as well in regards to the fact that a lot of these transactions and supporting information and documents, it's no longer in paper copy. A lot of it is, electronic in nature. So we have to, again, change our documentation and change our approach. So planning is going to incorporate all of these different areas so that we can make sure we have the necessary information to understand what are some of those risks that could have an impact on the plan's operation and administration. We're going to start by communicating with our plan sponsor and or those charged with governance in the form of an engagement letter that specifies the objectives of the audit, the type of audit being performed, in the form of the report. It's going to clarify the responsibilities as to what's management's responsibilities and what's the auditor's responsibilities. So this engagement letter is very important. You need to be sure you tailor that engagement letter for that client and for that audit period. You also have some other required communications here at the beginning of your audit process, specifically with those charged with governance. So you're going to communicate at the beginning of the audit, and this communication can be verbal or it can be in writing. Now, this communication, a lot of people choose to include this communication along with their engagement letter, which is fine as long as it includes all of the required communications. Other auditors elect to issue a separate letter to those charged with governance. It's entirely up to you, but you do need to include the information related to the overview of the planned scope of the engagement, the timing, auditor's responsibilities, the auditor's assessment of risk, and identification of significant risk. All need to be included with that communication with those charged with governance at the beginning of the audit. With this risk assessment process, We are going to go through and we're going to have to identify risk, whether due to fraud or error. And we have to document this risk assessment process to show our compliance with all 3 steps, including that identification, the assessment, and the response. So with the risk assessment procedures, we're performing procedures to obtain an understanding of the plan and its environment. And one of the reasons why we do that is, again, to identify potential risks at both the financial statement level and the assertion level. And this is going to include obtaining an understanding of the plan's internal controls. Now, the risk assessment standards have been around for many, many years now. They are not new. And until recently, there haven't been any new or significant changes to the risk assessment process as a whole. But because so many peer reviewers and other regulators were identifying many auditors that were deficient in their risk assessment process, they made some significant changes to the peer review process as well. Now, under the peer review process, if you miss any step of the risk assessment process, then that could be considered a non-conforming engagement, regardless of the amount of other detailed work that you perform. So you need to make sure you're documenting your compliance with each of these steps related to risk assessment. So here are your 3 steps. Step 1, you identify the risk. Step 2, you assess the risk. And step 3, you respond to that risk. And you have to show that you have completed each one of these steps. So step 1, identifying the risk. How are you going to identify the risk? Well, you're going to, first of all, obtain an understanding of the client and the environment, including any external factors that could impact the plan. What are their objectives and strategies and business risk? General information about the plan and the plan sponsor, the regulatory environment that could impact the plan. How you document your understanding of the plan and its environment is up to you. I know many of the service providers we use, such as Knowledge Coach and PPC, etc., they have forms to assist you in documenting this very information. But we're documenting this information so that we can identify risk. So understanding the plan itself, that would be the plan document and the adoption agreement. Understanding the different plan relevant provisions, including what are the eligibility provisions, what are the different types of contributions that are allowed, the different types of distributions, the vesting, etc. This is all part of understanding the plan and its environment. The nature of the plan itself. What type of plan is it? Is it a 401k, 403b? Is this the first time the plan's been audited? How does the plan sponsor measure and review the plan's financial performance? And we gather this information in a variety of ways. Inquiries of management and other individuals at the plan sponsor. We review minutes. We obtain information from the custodians and trustees. It's all part of documenting our understanding of the plan. So with this understanding of the plan, like I was saying, understand those relevant plan provisions, such as the eligibility. When do they vest? Who can make contributions and when? Because all of these items here are going to have a direct impact on our identification of risk. For example, let's say you've got what I would consider a straightforward type of 401k plan that only allows employee pre-tax deferrals and an employer match. But you compare that to the next 401k plan that allows pre-tax employee contributions, Roth contributions, catch-up contributions, employer match, profit sharing, and other discretionary employer contributions. Well, this second plan is going to carry a lot more risk than that first plan. So we do have to obtain this information because, again, it's part of step 1 of the risk assessment process. We also have to obtain an understanding of the plan's internal control, both at the plan sponsor and at the service provider. This is going to include understanding controls surrounding the control environment, the specific control activities themselves, because they could have risk here associated with a control that's poorly designed or that's not implemented. So we have to obtain this understanding. A lot of times plan sponsors may not have anything formally documented related to their internal controls. So it may take a little more effort on your part to obtain the necessary information to truly understand the plan sponsor's internal controls. Now, with their service organizations that they use, such as their trustees, custodians, third-party administrators, record keepers, hopefully they're going to have a SOC report that they can provide to you that would provide descriptions on the controls that are in place there at that service provider. The components of internal control that you're focusing on include the same 5 components that you'll probably remember all the way back from your auditing 101 days. You have your control environment, such as what's the overall tone at the top there at the plan sponsor. What is the process the plan sponsor goes through to identify risk and analyze those risks? The control activities themselves, that's the ones that we're probably most familiar with. What are the policies and procedures that are in place there at the plan sponsor to carry out the operation and administration of the plan? How do they share and communicate information, both internally as well as with their service providers? And how are they monitoring their own internal controls? So yes, we have to get an understanding of those interrelated control components. But with your 401k plans and your other DB plans, there are some additional areas that we need to be focusing and understanding of the controls for these areas. Things such as, what are their controls related to determining when an employee is eligible? How do they enroll in the plan? How do they make contributions to the plan? How are those amounts withheld from their wages? How are they remitted? How does the employee request a distribution? How do they request a loan? How is the loan administered? Payroll, financial reporting. Let me come back to payroll for a second. This is a very important area. Now, you're not doing a payroll audit of the plan sponsor, but you do have to obtain significant information about the payroll controls and process to be able to determine how that impacts the plan. So regardless if they maintain and do their own payroll in-house or do they use an outside service provider, who's responsible for entering the information into the payroll system? Who has access? Who can make changes? Who sets up the coding for the different definitions of compensation that are then going to impact the amounts that are withheld from the participants' wages? How do those deferrals get updated? Is the payroll system a combination of manual and automated controls? All of that has to be captured as part of your understanding so that, again, you can identify risk. Some additional areas that you're focusing on for internal controls. How do they provide oversight for their service providers? And how are they monitoring their service providers? What about their IT controls? How much of their operation and administration is in some type of electronic environment? Again, automated, manual. How are we determining the information that is shared back and forth between the plan sponsor and the service provider? Those general IT controls, how are they securing that information? Controls surrounding rollovers, forfeitures, record keeping, compliance with laws and regulations. So there's a lot to consider here. How you document your understanding of the internal controls is up to you. I generally use memos or narratives. You can also use checklists or questionnaires or any combination. It's entirely up to you. But you have to obtain and document this understanding of internal control for every single employee benefit plan audit that you do, period. There's no simpler way to put it. This is coming back to what I was just referring to when it comes to the payroll. The activities within payroll and HR Surrounding information associated with salary, hours worked, demographics, date of hire, termination, all of that has a direct impact on the plan's operation and administration. So some of these controls to consider do include authorization and information processing, eligibility and enrollment, contributions, distributions, how is information transmitted, who's responsible for approving, monitoring, and valuing plans investments, the preparation and closing process, maintaining the plan's tax advantage status, compliance with applicable laws, rules, and regulations. Internal control, as you can see here, is a significant part of this understanding of the plan and its environment, because we're in step 1 of the risk assessment, trying to identify risk. How are we obtaining this information about the internal controls? That will also depend on the plan sponsor, whether or not they have their controls and policies and procedures formally documented. If not, you're going to have to perform various interviews and have discussions with different individuals there at the plan sponsor to obtain the necessary information. You may have to inspect various documents, observe activities, even contact and get information from third parties as needed. The electronic environment also has to be considered, as I've mentioned a couple times. And I'm hesitant to say this, but I think it's still safe to say that every single one of your plan sponsors and plans are operating in some type of electronic environment. Yes, some plans may still utilize paper enrollment forms and change forms and distribution request forms, but a lot of the other activity is taking place in an electronic environment. So you may have some hybrid plans and some type of hybrid activity with all of the plans that you encounter. So that means that we now have not a higher, we still have the same obligation to obtain an understanding. It's just that the environment looks different because it's now electronic. So we have to evaluate and determine the source of the audit evidence, test the accuracy of that audit evidence, and evaluate the relevance and reliability of the information that's coming through that electronic environment. So we've got a couple of examples here, and these are pretty broad-based examples when it comes to some of the general IT controls. For example, if they've got a specific objective related to changes to the application system, programs are authorized, tested, reviewed, and approved. That's their objective. So then the control could be that they segregate duties amongst the different entities, such as end users, programmers, QA, library management, etc. Another objective could be that they have restricted physical access to various facilities, equipment, backup media, etc. So then the control they could put in place here would be make sure that there are formal procedures for granting and terminating access to these facilities. So with these examples, what they're trying to show you here is that you do not have to be an IT expert to obtain an understanding of the IT controls. Could be something as simple as obtaining information about, again, who has access to certain systems, how often is their password requirements changed, do they have encryption methods that they're using, how do they back up their data, are they using a cloud-based system, all of these different types of questions. But again, because of this electronic environment, we can't overlook it. We have to document our understanding of those controls, regardless if it's in an electronic environment or paper-based environment or some combination of the two. For those plan sponsors that are using service organizations, regardless if it's for trustee, custodian, record keeper, or any and all of the above, we have to still obtain an understanding of the controls there at that service provider. And the best way to do that is to obtain a SOC report from that service provider. And this could primarily be a SOC 1 report that we want. And that SOC 1 report will either be a type 1 or a type 2. At a bare minimum, you want a type 1 because the type 1 will describe the controls at the service provider, but ultimately what you would like to have would be a type 2 SOC 1. Because with that type 2, not only do they describe the controls, but they test those controls for operating effectiveness. So with a type 2, you can reduce your control risk for the controls located at the service provider, and then ultimately reduce your testing for those controls that were tested at the service provider. But you have to properly document all of this. And you have to be very careful that you're only reducing your control risk and procedures for controls that were located and performed at the service provider. Within the SOC report, they will have something called user entity controls. And these are controls that must be in place at the plan sponsor in order to help ensure that the controls at the service provider work properly. So if you're relying on that type 2 SOC 1 report, you're going to have to test those user entity controls to determine that they have been implemented. Also, please be careful to make sure you do obtain the correct SOC report for your plan, because a lot of times the service organizations will have different SOC reports. The SOC report must cover at least 6 months of your plan year. If it doesn't cover 6 months, you can't use it. If you've got a SOC report that has a fiscal year end, you're responsible for understanding controls for the entire plan year. So if the SOC report has a fiscal year end, you're going to have to get a bridge letter or gap letter that says there were no changes in those controls for that time period. If the SOC report contains exceptions in the testing, then you're going to have to use your judgment to determine if those exceptions have an impact on your reliance of that SOC report. Now, if you encounter a situation where a service provider does not have a SOC report, you still have to document your understanding of the controls at that service provider in some manner. So I did pause there intentionally because I wanted to let that sink in for a second, that if the service provider does not have a SOC report, you still have to obtain understanding of the controls of the service provider. Hopefully they will have something they can provide to you, or you can speak to enough individuals to get a basic understanding of the controls of the service provider. If not, worst case scenario, you may have to go visit that service provider. Now, you could have more than one service provider for that plan. So that would mean you would need to review each and every SOC report for that plan. In addition to understanding the plan and its environment and internal controls, you're going to be performing brainstorming sessions. The purpose of this brainstorming session is, again, to help you identify risk. Now, you have to document when the brainstorming session took place and who attended, but be sure you document the actual risk that you identified as a result of this brainstorming session. So many times I see auditors where the only thing that they have documented is on a checklist that says who attended and when, and then the checklist lists out all of these things that should be considered, but there's no indication anywhere of the actual risk that are relevant to that plan. So be sure you document the actual risk relevant to that plan. With this understanding of the entity and its environment and internal controls and your brainstorming session, now you're summarizing all of these items because it's step 1 where you're trying to identify the risk. And this is the risk in all of these areas that we've talked about: the control environment, the specific control activities themselves, the plan sponsor's risk assessment, information communication, and monitoring. Because once we have these risks identified, we move on to step 2, which would be to assess the risk. And once we then assess the risk at high, medium, or low, then we're going to respond to that risk. And depending on the nature and the assessment, that will then drive the appropriate response, to where maybe we need to assign more experienced personnel, or we need to provide more supervision, or we need to change the timing of our procedures. It could be incorporate more unpredictability Any combination of those could be our responses to those identified and assessed risk. So, still here in step 1, trying to identify risk, we have to understand who the parties in interest are to determine whether or not we have any risk associated with the transactions between the plan and those parties in interest. So, ERISA Section 3, paragraph 14 defines a party in interest as any fiduciary, counsel, or employee of the employee benefit plan. Anybody who provides services to the plan, such as custodians, auditors, investment manager, payroll companies, all of those are service providers. They all get included on that list of parties in interest. An employer whose employees are covered, an employee organization whose members are covered, and then an owner, direct, or indirect of 50% or more of the interest in the employer. All of these individuals and entities and their relatives are considered to be parties in interest. These are some of the common parties in interest that you'll identify for your EBPs. I think I've mentioned most of these already. But what you're concerned about is whether or not the plan is engaging in prohibited transactions between a party in interest and the plan. Because if you identify a prohibited transaction, then that has to be reported. So here in step 1, you're trying to get an understanding of those parties in interest to determine what your risks are related to the transactions between the plan and the party in interest. These are some of the common areas of non-compliance as noted by peer reviewers that are related to risk assessment. And these are in no particular order. Failure to gain an understanding of internal controls when identifying client's risk. So I said this earlier and I'm going to say it again. You have to obtain an understanding of internal control on every single employee benefit plan audit period. If you fail to document your understanding of internal control, that's going to result in a finding by a peer reviewer. It may result in that engagement being deemed as non-compliant, which could then result in either an MFC or even a failed peer review. So you have to document that understanding of internal control. So as the auditor, you are expected to gain an understanding of internal control to consider what could go wrong, to identify the controls to mitigate the financial risks, and then evaluate the possibility that controls are capable of preventing or detecting and correcting material misstatements. Some of the other areas of non-compliance noted by peer reviewers include the fact that auditors may incorrectly indicate that the standards don't apply because the client has no controls. Every client's going to have controls whether they realize it or not. Other areas of non-compliance is where auditors incorrectly defaulted control risk to the maximum and then didn't understand or obtain that understanding of internal controls. Even if you're leaving your control risk at the maximum, you still have to document your understanding of internal controls. Other areas include the fact that they reduced control risk without testing the relevant controls. You cannot reduce that control risk unless you test those controls. Other areas include insufficient risk assessment. They have identified the client's risk and material misstatement by gaining an understanding of the client and its internal control. Failure to link procedures performed to the risk assessment by not assessing risk at the appropriate assertion level, because some auditors were assessing risk at the account level, has to be at the assertion level. So as you can see here, lots of areas of non-compliance being identified by peer reviewers. If any portion of the risk assessment process is missing, then that could be constituted as a non-compliant engagement. So at a minimum, that could result in an MFC from the peer reviewer. It could be considered a pass with deficiencies or even a failed peer review report. And they take this so seriously that, again, It doesn't matter how much work you do when it comes to your substantive testing. If any portion of these 3 steps are omitted, that could be considered a non-conforming engagement. So there's lots of misconceptions here that have been driving these nonconformities over the years. Whether it's the auditors not understanding what the rules are, or they're just not seeing this as a critical component of the financial statement audit, or auditors may feel additional competence is not needed for an EBP audit. Over-familiarity with the client may reduce the testing. Other excuses is that they felt like they could still perform this audit even though that they're not in compliance with the standards. Auditors may not understand the need to thoroughly test participant data, again, because they're not familiar with the rules and regulations that govern these plans. So there's been lots of misconceptions over the years when it comes to auditors failing to comply with the risk assessment standards. So again, wrapping up here, step 1, some of these significant risks that are common to defined contribution plans when it comes to management override of controls, not maintaining those individual participant account balances, the valuation of hard to value investments, any types of plan mergers. These are all considered to be examples of significant risks that are common to your defined contribution plans. Again, various risk factors here that need to be considered, including risk related to plan management and integrity, an overall commitment to accurate financial reporting, control environment, impact of computers and technology, the overall nature of the audit engagement itself, whether it's a first-year audit or a plan that's terminating, engagement history and client relationships. All of these are potential risk factors. And this list is not all inclusive. These are just a few examples. The financial stability and profitability of the plan sponsor could also be a potential fraud risk factor. Significant related party transactions not in the ordinary course of business. Lack of oversight by plan management on outside service providers. If you identify a fraud risk, you have to respond to that fraud risk. And it has to be a specific response. It does not mean that you're testing for fraud. It just means you're responding to a potential fraud risk factor. And these are just some additional examples here of potential fraud risk factors. Inadequate monitoring of controls. They lack an understanding of the major regulations that govern the plans. And so again, all of these items we've been talking about up to this point, have been part of this step 1, identifying risk. Then you have to assess those risks. That's step 2. And step 2, when you're assessing the risk, is just assessing that identified risk as high, medium, or low at both the financial statement level as well as the relevant assertion level.